What's up, you guys? It's Nathan here. 5 more rate rises by the RBA? Well, if Goldman Sachs' top economist is correct, Australia will see 5 more rate rises in the next 6 months, which will take the cash rate to 4.1% before dropping steeply in 2024. Goldman Sachs chief economist Andrew Boak said they don't expect the RBA will risk falling behind the global synchronized tightening cycle. They expect a 25 basis point each month between now and May 2023, which will mean the terminal rate will hit 4.1% according to their prediction, followed by a 1.1% drop in 2024 to bring the terminal rate to 3%. Boak said that their revised terminal rate forecast sits on the hawkish extreme, but broadly in line with market expectations. Shane Oliver, chief economist at A&P Capital, warned that if the cash rate hit 4.2%, it'd likely push the economy into a recession and drive home prices down by 30%, shaking up the nation's financial stability. The RBA has not wavered from their intention to return inflation back within the target range, at the same time keeping the economy on an even heel. The Reserve Bank has been very clear in saying that they have no preset path and will walk a narrow road. Goldman Sachs economist is predicting a 15 to 20% drop from peak to trough in housing prices, but he said the fall would be orderly and manageable. This is mainly due to the large pool of savings that would soften the effects of the rapid rate rises on homeowners. The RBA has updated its own prediction on peak inflation to hit 8% later this year. Both Westpac and ANZ have projected that the peak cash rate will hit 3.85%, while NAB forecasted 3.6% and Commonwealth Bank 3.1%. Jen, we can see there's a bunch of different forecasts out there. What's actually likely to happen?
I've got some figures here from only May this year, and Westpac themselves are actually predicting the cash rate only to be at 1.75% now, and we're at 2.85%. That was only a few months back. With some of these forecasts, they're not always going to be accurate. It's more kind of like a weather looking forward and saying, like, this is what could happen based on what we know now. And things are constantly changing. From what we've seen in the market and with some of the forecasts, it's looking like CBA's estimation is going to be more likely. Even in previous downturn cycles, we've only seen from peak to trough sort of 12 to 18 months, which would play out where later next year, the Reserve Bank starts easing things up. It's looking pretty unlikely it's going to get as bad as what Goldman is saying.
As we talked about earlier, the RBA has no preset path. Trying to predict where the cash rate's going to peak is quite difficult. But if we look at some of the data that we've seen, we know inflation is going to peak at the last quarter of this year and then potentially start to come backwards. So if we see in the first quarter of next year inflation coming down, it might mean that the Reserve Bank can take the foot off the pedal and start to slow down on some of the rate hike, which could mean the peak in the cash rate could be lower than expected. But once again, it's anyone's guess from here. Jaden, you've got some statistics from earlier in the year from what Westpac was saying in their predictions, and we can see straight away that it's really anyone's guess.
Back in May, we looked at Westpac's forecasts. These are the current ones, but they were saying as of May this year, May 2022, the cash rate in December right now would only be at 1.75%. In reality, we're actually at 2.85%. These things sort of go through and the market's constantly changing. These forecasts are also going to change. But a question we are getting asked a lot at the moment is, should I fix? If I have a home loan, I'm worried about the cash rate going up and up and up. Doesn't make sense to me. What I've done here is overlay Westpac's forecasts on the cash rate over the next, between now and June 2024 and put in ANZ, say, for example, current 2-year fixed rate of 5.49% versus a variable rate of 4.75%. The other thing I've factored in here, which I guess it's anyone's guess, is what we've seen in the current rate cycle is the banks have only added on what the Reserve Bank has increased the cash rate by. So if the Reserve Bank has increased the cash rate by 0.5%, all the banks have increased their home loan rate by 0.5%. In previous rate tightening cycles, the banks have done different things. One bank might increase the rates by 0.6%, one might do 0.8%, others might do 0.4%. What I've included in these figures is an extra 10% on top of what the Reserve Bank's doing. As a part of some of the bank's annual reports this week, they've said their net interest margin, so that's the amount they make on home loans, has been squeezed. So Westpac's was reduced. Pre-COVID, it was above 2%. Their net interest margin right now is at 1.9%. So it's getting more fierce, and it's probably looking more likely that the bank's going to try and reclaim some of that lost margin in future rate rises. But looking at the figures, if you compared, if you're a variable rate at the moment, or if you looked at fixing for that 2 years, the difference in repayments pretty negligible, because like Nathan said, and like we said throughout today, while even Westpac's predicting a peak cash rate of 3.85% up until March 2024, it's going to start to come down back in June 2024. It's a really tricky one. I think with fixed rates, like we've covered before, there's no right or wrong answer. It's going to depend on your situation. If you're concerned about stability, if you're wanting to know the certainty of your payments is more or less going to be the same amount, obviously the loan balance is going down, so that's why it changes a little bit there. But if you're happy to pay, around $2,835 a month, if you've got a $500,000 home loan, it makes sense. Whereas the variable, it goes from $2,600 all the way up to 2,950 as everything increases. So keep that in mind. Everyone's situation is going to be different. It's worth talking to a mortgage broker like us. We can help work out what's going to be best in your individual circumstances.
Even what's interesting that we've seen recently is some of the banks' fixed rates have started to come down. We're starting to see some 2-year fixed rates with a 4 in front of it. That gives you a bit of an idea of where they're forecasting, where the average rate might be over the next couple of years. One thing we have also seen is that borrowing power has reduced by quite a substantial amount. The banks need to stress test home loan customers when they're doing assessments. Now, this stress test involves adding 3% to the current mortgage rate to see if you can handle potential rate increases. What we saw previously before all these rate hikes was this stress test was only 2.5%. And now, as interest rates have gone up, this stress test and passing it has only got harder with higher rates and the higher stress test amount. To give you an example, a family of 2 kids with a combined annual income of $150,000 could potentially borrow a maximum of $995,000 only 7 months ago. Now in November, as rate hikes have hit, borrowing capacity has reduced to $781,000. That's $215,000 less, or 22% drop since the rate hike started earlier in the year. If the cash rate does hit 3.85% like Westpac is predicting, for the same situation, the borrowing power will reduce a total of $284,000 since the rate hikes began. For a single person earning $100,000 with no debts, no dependents, their borrowing power fell by $160,000 over the past 7 months with all these rate hikes. If the cash rate hits 3.85% like Westpac's prediction, that would mean that borrowing power would reduce by 28% or $215,000. Jade, what can borrowers do if they're being hit by reduced borrowing power? Is there anything that's there that they can actually potentially do to unlock extra capacity?
There's a lot of things you can do. So don't feel trapped if your lender says there's not enough borrowing capacity. The first thing you can do is shop lenders, speak with the broker. Different banks have different tolerances, even as far as your living expenses. Some banks will use kind of a preset scale. Other banks will use your actual expenses and consider that as far as your capacity. So keep that in mind. Look at your credit cards. As we covered before, the banks will assess your credit cards and personal loans on the limit. Although you might have a $5,000 credit card and you pay it off every month diligently, the banks don't look at that. They look at the total limit, the $5,000, and that can reduce your borrowing capacity up to 5 to 6 times. So that could reduce your borrowing capacity by $30,000. That can make a pretty substantial difference. The other thing is run different scenarios. Again, with different lenders have different policies around overtime, bonuses, car allowances, meal allowances, uniforms, all sorts of stuff. And some banks will take your overtime at maybe 80%. So you're losing 20% of your income straight off the bat, while other banks will take it at 100%. There's lots of different things you can do there. Brokers like us and Hunter Galloway can help you out with working out what's going to work in your situation and see what's going to maximize your borrowing capacity today.